Good morning. I'm Gord Long with the Financial Repression Authority. As part of our ongoing series on the Austrian School of Economics, I have Robert Blumen joining us this morning. Welcome, Robert.
Great to be here, Gordon.
Well, thank you for joining us. I was looking forward to this discussion. I know that you brought some really great slides here, and I want to jump right in. But before we do, Robert, could you give our listeners a bit of an overview of your background, the things that you're involved with?
Yeah, I have a degree in physics. My career is software engineering, and I have been reading and writing about the Austrian School of Economics, and once in a while speaking about it for many years.
Well, that's exactly one of the reasons we wanted to have you on, because we've had a number of people joining us talking about the Austrian School, but I think that you've netted it out very, very well of what the core tenets are that people need to be aware of today, and then what the key elements that they need to look at in terms of this era of financial repression to really take advantage of it. So why don't we just kick it off, Robert, with how do you describe the Austrian School of Economics, and then let's go through these core tenets that you built.
Sure. Well, Austrian school, it's a school of thinking within economics that integrates the most sound ideas from medieval thinking, classical economics, and neoclassical economics into one coherent theory. Professor Salerno, who you had on another episode of your show, he uses the term realistic, meaning Austrian economics tries to provide a description of the world that we live in that helps us understand phenomena relating to exchange and production.
And these tenets that you have listed here, I guess we have 26 here on this list. Could you take us through them?
Yeah, well, Austrian economics starts from the idea that all economic action ultimately starts with the individual, and with individual valuations. Individuals prefer some things in relation to other things, and that drives everything we know about the economic world, including division of labor, exchange, money, production, capital accumulation, and savings. So that was where they started from, and over a period of hundreds of years that this body of knowledge has accumulated, the different thinkers have contributed a number of insights about money, banking, business cycles, socialism, different economic systems, regulation. They've really looked at the whole range of economic phenomena and tried to apply the same analytical methods to understanding them.
Do you want to highlight some of the core tenets, of the key ones on the list?
Sure. Well, let me just scan down this list. One of the areas that the Austrian school has contributed a lot is monetary theory. Start with the idea of money as an evolutionary solution to the problem of barter. Now, barter comes about because of division of labor, that people can be more productive at doing what they're best at and exchanging with other people than they could by producing everything themselves. So specialization is a natural response to that fact. Barter, though, creates the problem. If I have a good and I want some other good, I produce apples, I want chickens, I have to go and find the person who produces chickens, and maybe he doesn't want apples. So Karl Menger speculated that people, very forward-thinking people, would adopt a strategy of indirect exchange. That means look around for some good that's very marketable, something that probably everyone wants or a lot of people want, and exchange the apples for that good. And then just park your past production in that good for a while until you see the opportunity to exchange that good for something else. So that was the origin of indirect exchange. Now, as many people in the community started acquiring the same good for this purpose, it became more and more marketable until at some point there would be one good which was the most marketable good, and most other goods could be exchanged for that. So that was the evolutionary origin of money.
It's interesting, Robert. We just had Ty Andros on talking about in detail the indirect exchange. And one of the things he was pointing out that how that evolved to today is exchanging paper, that is fiat currencies and things that are unbacked and are created without any scarcity by the government for real value, real assets, real production that at a later point could be exchanged possibly for currency. And so the reference would be gold, silver as example. So it's actually taking place in reality today with a new, not a new twist to it, just a reformulation of it.
There's one step in between what I said and what your other guest said. The emergence of gold and silver as the solution to what is the best money. I don't think this is particularly Austrian, but many people have observed that the ideal money has 6 or 7 qualities. I don't know if I'll be able to remember all of them, but something that's difficult to produce, easy to recognize, very durable, meaning it doesn't wear out, something that originated through Menger's process of a good that had an existing use for direct consumption within the community before it became adopted as money, and something that has a value to weight ratio that's neither too high nor too low. If it were too high, then it would be very difficult to measure it and to deal with very microscopic quantities. But if the value to weight ratio is too low, then you'd be dealing with carrying hundreds of pounds of some type of commodity around with you. Out of all the different goods that have been used in human history for money, through a competitive process in which different monetary commodities were in competition with each other, the gold and silver emerged as the best choice.
But all of those points reflect that whatever you choose, it has its ability to be a store of value, that the value in it stays with it over periods of time. It can't be debased, it can't be changed, it can't be manipulated or fraudulent in terms of being printed, if you would. So that's why things like gold and silver have appeared. But it doesn't. My point I'm making, it doesn't restrict it to gold and silver. It can be anything that has those qualities you pointed out.
Menger point out there are 3 properties of money: medium of exchange, store of value, and unit of account. Menger's view was that medium of exchange was the defining property of money, and that store of value and unit of account were consequential properties. Unit of account comes about because once you have a single money or maybe 2 monies in general use, then you can start to do accounting in terms of the monetary unit. And accounting was a huge advance in the development of civilization because it enabled business firms to determine if they were making a profit or a loss. If you're in a barter economy and you start out with 10 apples, 8 chickens, and 4 barrels of wheat, and now 6 months later you have 18 apples, 9 chickens, and 7 coconuts, did you come out ahead or behind? How do you know? When you have money prices and monetary accounting, you can reduce everything to a single number and net that out and determine if you made a profit or a loss. And a profit is very important because it means you replaced all the economic value that you consumed in production and have a little bit left over at the end. It means you're creating a net economic value for the community when you make a profit.
And this all works. And why it's evolved is that currency of exchange, we'll use this word money, as long as it does maintain a store of value. And so as we went to a fiat currency, that is money that isn't backed by anything other than the good faith of the government's ability to tax, all of a sudden, whether you're making a profit becomes a lot more difficult thing to look at because you're trying to measure inflation, debasement, the currency it's denominated in, and all of those are calculable. But when you start to manipulate them, you can start to get mispricing, malinvestment, lack of price discovery, etc. And that's the whole foundation of sound money. Am I correct in that?
Sure. As I said, we calculate in terms of the monetary unit, and it's not because money has constant purchasing power. This is something Austrians really emphasize. Money in a sound monetary system, money is still a good, and like all goods,
yes,
people are constantly changing their demand and supply. The supply in a sound monetary system would be due to mining, which doesn't produce a lot of money, but there were periods where the money supply of gold grew very rapidly because there were huge discoveries that were quite large in relation to the existing monetary supply. But money does not have constant purchasing power. The reason we calculate in monetary units is it's the best we can do. There is no better solution. When you get the government in the business of printing money, then it adds an additional instability to the supply side and makes it more difficult to allocate resources using monetary calculation.
Robert, how would you differentiate everything we've said so far with other schools of thinking? For example, the Keynesian school of economics.
Keynesian economics, I don't even consider it to be economics. It starts from the basis that
I think people would disagree there, but I support you.
It starts from the basis that there are these aggregates like national income, total wages, total spending, and that somehow these aggregates interact with each other. The Austrian view is all economic phenomena can be understood in terms of individual action. We start from that, and then we understand prices, money, wages, business firms, and that is what in a university course would be called microeconomics. And from there we can understand what I would call macroeconomic phenomena, but it's all founded on the base of microeconomics, which then goes back to individual action. Within the research field of macroeconomics, they realized that Keynesian economics has no foundation on microeconomics. There's a whole research program. It's like trying to build a bridge from two sides of a river, and hopefully it meets in the middle to create a microeconomic basis for macroeconomics. It's completely its own thing. And the theory itself, it's very illogical. It assumes that markets don't clear. That is the foundation of Keynesianism. Markets don't clear. So prices are stuck where they are, and that all the adjustments have to take place in terms of quantities. It's a denial of the price system.
But isn't it healthy when markets do clear, because then it clears out malinvestment? It makes sure that we get correct pricing that can get distorted for various reasons. Isn't things such as a recession, though as much as we don't want them, a healthy phenomenon?
Sure. Markets clearing, it's the foundation of all economic phenomena, and that is required for resources to be allocated in a way that's consistent with people's desires and preferences.
I don't hear any politicians or central bankers talking about needing a market clearing event.
Yeah, one of the curious things about economic history is why did the Keynesian theory receive such rapid and dramatic adoption by the economics profession? It was introduced by Keynes after a couple of failed attempts in the early 30s. And some very cynical people have said it provides a pseudo-scientific rationale for people in government to do what they want to do anyway, which is tax and spend.
You know, I haven't heard anybody say it the way you just did, but it's instinctively is what it feels like at times, that it was created, because it really, in many cases, is not logical and is proven not to work. Most classically in the 70s, you can only have inflation in a Keynesian world if you're at full employment, full production, and therefore there's a higher demand for the goods than there is supply. And there we had neither and we had low unemployment, we had our high unemployment, a lack of capacity, and yet we had inflation running 19-20%. It was just through the roof. So you can't, which poo-pooed the whole school of Keynesian economics, but that's a whole school in itself, discussion in itself. So it has changed. Any of these other key tenets that you'd like to talk about?
Talk a little bit about Mises' view of socialism. He used the term as it was used. First, I'll say Mises, meaning Ludwig von Mises, who was the most original thinker in the Austrian school and contributed the greatest amount of new ideas. At the time he was writing in the 1920s, the word socialism meant central planning. He created this amazing critique of central planning based on the idea of monetary calculation, which we were talking about a few minutes ago, that you can only tell if you're increasing wealth or consuming wealth through the use of money prices. You need to compare the amount you spend and the amount you take in, see if you have a profit. And that can only be done in a monetary system with sound money, with money prices, and in which prices are set on the market through a competitive bidding process by entrepreneurs who are trying to allocate resources. If you try to replace that with a central planner, they have no idea what the alternative uses of different goods are, and they have no way of comparing whether they should produce more cars, apartment buildings, shoes, or any other thing, because they don't have prices as a guide.
Do we have a sound money system now operating generally in the developed economies?
No, what we have is a Frankenstein monster monetary system that's gone through a series of stages to evolve from the gold-based monetary system of the 19th century to the pure fiat monetary system, and now with quantitative easing, where central planners believe that they can print wealth into existence by raising asset prices.
So creating money is not creating wealth.
Absolutely not, Gordon.
And I believe that, but I don't think generally people see a difference. They believe that if the government can print money, create it, and hand it out, wealth is being created. Maybe purchasing power is temporarily being given to the recipients, but wealth is actually being destroyed.
There's no net creation of wealth. For example, if asset prices go up, all that's happened is people who own assets are relatively better off than the people who don't. But ultimately, the people who own the assets, if they want to consume something, they have to sell their assets for money and then go out and buy the goods and services they want. If you think about, for a moment, if asset prices were much, much lower, then young people who are trying to save for retirement or entrepreneurs who are looking for bargains, their position is improved because they're able to buy more fractional shares of corporations for less money.
Robert, let's moving along. Let's switch gears here a little bit and talk about the key elements of the Austrian school in this era of financial repression for investors. So, what should investors really focus on? And I know you got a list here of the school of Austrian school that would be very applicable to them.
So, Austrian economics, it's not an investing philosophy in the way that, say, value investing or growth at a reasonable price, but there can be situations where your investment returns would be dominated by macroeconomic factors. And those situations have occurred a couple of times in recent decades. One would be the tech bubble and tech bust, and the second would be the real estate bubble and real estate bust. Both of these were classic Austrian business cycle boom and bust patterns. And if you could have recognized those, you could have either avoided the bust or maybe made some money on the short side, or possibly just stayed away from sectors that were being artificially boosted by the artificial boom and looked elsewhere for good values.
Is that not maybe what we have again this time? I'll call it a central bank-driven boom. That is zero interest rates, cheap money. So, as you mentioned, the dot-com bubble was an explosion of technology that turned out to be not distributing free cash flow sufficiently. We all understand the 2008 financial crisis associated with housing that turned out to not to have the residual values they thought. And now we've got money chasing assets in the terms of the stock market that don't appear to be funded in pure valuations. Is that an overstatement?
Yes, Gordon, I agree with you on that. I'm reminded of a comment made by Peter Schiff, very Austrian thinking investor. He was being interviewed on a media program, and he said in 2007, we're in a housing bubble. The host said, that can't be. We just had a bubble 7 years ago. Those things come along once in a generation. And yet here, I think we're in the third in my lifetime of these artificial credit-driven bubbles.
And it seems to be because we're creating exponentially more and more credit, which is needed to keep a debt-based economy going, because money can, as you well know, can only be lent into existence by the nature of the fractional reserve banking system that we currently have. And when we get to the debt to the level that we have, there's a problem. And especially when all debt has to have collateral behind it. And that's based on wealth. And if we're not creating wealth, you can't create new collateral to support the debt. Meanwhile, the debt's burning off interest. I think that's common sense, but it seems to be lost somehow out there.
Yeah, I think you're right about this, but I don't look at the problem being so much defined in terms of debt. It's where the money goes and how the money distorts the price system and leads people to make uneconomic and irrational decisions about what to produce. And that's where the real problem is. It's in the real side of the economy. It's driven by debt, and debt is driven by political factors, but it creates problems in the productive part of the economy.
Well, without question, I fully agree with that. And the easiest way of, of describing that is we had quantitative easing and we've created so much new credit. But what's happened is we've had $9 trillion of carry trade in U.S. dollars that's went to emerging markets. And we did quantitative easing to bring demand forward to stimulate the economy, which it sort of did. But what we did is all that money went out into production and supply. So we had this massive overbuilding, overcapacity from China through all the emerging markets. And now we have no pricing power, and we're seeing that in commodities falling off.
So the way you're describing that, it sounds a bit more to me like Keynesian style thinking. The Austrian school accepts something called Say's law from the 19th century French economist J.B. Say. Say observed that the way that you demand one thing is by supplying something else. In other words, supply of one thing constitutes the demand for something different. If you extend that to the macroeconomy, then aggregate supply is all of the things that are produced, and all of that aggregate supply constitutes demand. So aggregate supply and aggregate demand are one and the same thing. There cannot be such a thing as general overproduction. The Austrian school focuses on problems with proportionality, that instead of producing one thing, we produce too much of another thing, that the proportionality within the productive part of the economy gets wrong. If you produce too much of one thing, then the price of that thing will fall, and the people who produce that good may not be able to cover their costs when they sell it. It's these errors of proportionality that really drive the distortions that are created by money printing, and not problems with aggregates of oversupply in general.
I agree with that. Another way of kind of thinking of the problem in that, look at China right now. They've built ghost cities. There was no demand to build all of these ghost cities and ghost malls, but they did. and for various reasons. Now what we have is the steel industry, as we talk today, in complete freefall now in China because there's no sustained demand at that level that they've had with this massive build-out. And so all of the pricing are collapsing in it. So there was no demand, but there was an overstimulation of supply for whatever set of reason because of government policy.
In China, I am not sure how to apportion the blame between a credit bubble and central planning. It's those two things together that are causing them to waste a lot of resources on things that, as you said, no one really needs. If you could have a whole city for free, that would be great. But it's not free. It uses up scarce machinery, resources, and labor that could have been put into something else that people actually wanted and had the ability to pay for.
But you make a very valid point. It's difficult to determine what it is from the central planning or over the excess credit and what really drove it. Robert, we're going to have to wrap now. Are there any key messages you'd like to leave with our listeners that how they need to think about using the Austrian school of thinking today?
Most people I meet who are familiar with the Austrian school learned about it just through reading and study. It's a great area to invest yourself in self-study if that's something that you care about. There's a ton of free resources on the internet, Mises.org, or whatever country your listeners live in. A lot of countries have their own Mises Institute. I think it can be a really rewarding pursuit and help you understand a lot about the world.
What attracted you initially to really studying the Austrian School of Economics?
I was always curious about economics, and I met some libertarians, and they told me about Murray Rothbard, who is an Austrian economist. So I decided that's how I'm going to learn about economics.
Robert, thank you very much for sharing this with us today. It's been an interesting conversation. How could our listeners follow any of your writings or your podcasts or things that you do?
I write from time to time for the Mises.org website, LouRockwell.com, and just Google is a good way to find out about me. I have my own podcast called Software Engineering Radio, which is about computer software, and you can find that with Google as well.
Thanks for your time, and we're going to have you back again and continue on this subject. So thank you for your time today.
You're welcome, Gordon.
Bye-bye.
Bye.